we'll go ahead and get started. Thanks everyone for joining us here today. I'm Alessa Huber. I'm an attorney at Cooper Huber. We're a business litigation and transactional firm. So our goal here today is to provide a high-level overview of tax and legal considerations when selecting an entity or a structure for your business. We have two very accomplished speakers. We've got Miguel Centeno, the managing partner at Tax Hack Accounting Group. Miguel founded Tax Hack Accounting in 2016 with the goal of providing strategic thinking for emerging industries, including e-commerce, digital marketing agencies, and tech. He's been featured in several major publications, including the Wall Street Journal, Airbnb.com, Fox Business, and CNBC. We've also got Danny Cooper on the legal side. Danny is the co-founder and my partner over at Cooper Huber. Danny acts as outside general counsel to privately held businesses. He's received a number of awards, including Super Lawyers and Preeminent AV rating, which is the highest possible rating for both legal ability and ethical standards. So thanks very much, everyone, for joining us here today. And without further ado, Miguel, why don't you get us started?
Absolutely. And thanks again, Alessa, for a wonderful introduction. I'll just get us kicked off here. You are in the right place if you're here to talk about entity considerations for businesses. You're not in the right place if you think that 20 minutes with us is going to answer all your questions. Our intention is to give you a flavor of some of the things that we think about, some of the things that we hear from our clients, and give you the benefit of some of those insights. I usually like to start with, do I even need an entity? And there's some parts that we can consistently speak to. There's others where we say, talk to your attorney. We'll get into those in a second. Luckily today, we have legal on this call. So you'll hear a little bit about what we usually leave out getting started. So big question is, what are the risk and reward considerations in your business? Obviously, it's different if you sell a cup of coffee and you're doing a farmer's market on the weekend versus building a business where you have employees, contracts, multiple vendors, and are really building something out at scale. So oftentimes, we usually take our clients through a process of where we try and get them to internally think about risk, even before getting into legal, before they're really thinking about it. Oftentimes, if scale is small and risk is small, it's often the case that we maybe consider what business would look like if they were a sole proprietor without an entity. But again, I'm just painting the background for how to start thinking about when an entity makes sense. And hopefully you'll get a sense of that from a tax perspective over these next few slides. I've just highlighted some important things here that I'll speak to quickly. Liability is big. I'm going to hand that over to Danny in a second, but the economic benefits is where tax comes in. And it's going to depend on the size of business, and it's going to depend on what your goals are, what your cost structure is, and what other businesses you may already have. So I've listed here business segmentation, something that a lot of our entrepreneurial clients get really, I think, maybe oversimplify, where they say, hey, I've got an LLC. I'm going to put 5 different businesses in it. They want to start a new venture and they say, oh, I'll just run it through my LLC. That's not exactly how you want to run things, because they have different cost profiles and they have different risk structure. And sometimes they're capitalized different, or they have different ownership. So business segmentation is something where we start saying, hey, you might want to start separating out maybe that farmer's market from your e-commerce business, which you have separately, or your practice that you're running. If you're a professional services business, you definitely don't want to have that tied up with a Shopify store, for example. And of course, the other thing to think about that oftentimes gets missed, we won't get into it in this call as much, is insurance. So protection, be the protection that you might get from entity structuring. Something that we encourage our clients to do is consider what general business insurance, commercial insurance is. And depending on the different types of business that you are, that's something that if you can just write it down quickly, what is the best insurance for my business, is not going to be something that necessarily has a huge tax benefit, but it's going to be kind of a no-brainer that we're not going to cover in this call that you should look into. So with that said, let's hop into what entity selection and tax consideration look like. And just a little bit about our firm. I happen to be managing partner of Tax Hack Accounting Group. We are a collection of different tax practices that focus on different niches. So Yes, we focus on emerging tech and industries. We also have other practices that are focused on real estate, for example. It's really focused. So when you think of us as a collection of specialty tax practices, and we usually try and find ways that we can have a specific playbook depending on your type of business. And that's kind of the driving force here, is the type of business you are, including cost structure, goals, other businesses you have, other assets you have, is going to drive the conversation of what entity works best for each business. Here I'm showing the 4 main entity structures that we talk about when we advise a client, starting with a sole proprietor. So by default, if you start a business tomorrow and start receiving income, the IRS says once you earn $400, it's taxable. You are a sole proprietor. Now, it's important to mention this because, like I said, a lot of times if you're just starting out, this is where you're going to be. This is what the IRS is going to consider you as, and it's going to be something that you can just get started. So a sole proprietorship is somebody who's individual. That's important because if you have someone else in your business, that's going to be by default a partnership. So you can see here in that second tile, we've actually noted that you can be a partnership in an LLC. So oftentimes when we have partnerships and we put agreements, we have legal put agreements together, but you've got multiple shareholders. By default, again, the IRS can consider you a partnership, even without an LLC, by the way. So a lot of people don't know that you can be a partnership, although we don't necessarily advise that without actually having an LLC. Now, the number one question we get, and we've got some slides dedicated to it, is that third tile is, how does an S Corp benefit me? I'll talk about that shortly. But the main reason that we use S corporations is when we've achieved some kind of scale and stability. Once we've reached a level where we know we've got business as usual, we can usually quickly assess whether or not it makes sense to be an S Corp. When does it not make sense to be an S Corp? Well, if you're testing out a business, if you're doing something that only has a 1-year horizon, the administrative requirements of getting the S Corp benefits are not necessarily going to outweigh the cost and the administrative cost of the S Corp is going to outweigh the benefit. So we'll get into a little bit of how to think about that, but it's really important to note that an S Corp is a tax classification, meaning you can be an LLC or you can be a C Corp. You can incorporate or organize originally as one of those and then get treatment from the IRS to be an S Corp. Talk a little bit about that in a second, but just note that it's not really an entity of itself. It is a tax classification, but it is a very important structure to understand if you don't already. And then lastly, we have the C corporation. Oftentimes, C corporations are very important in the context of raising money. If there's capital going to be raised, whether VC or PE is going to be involved. We have several client cases where we've got somebody who set up an LLC. They created some tech. They've been running for about 6 months. They go raise money. They get a term sheet. And then the VC tells them, hey, you've got to go convert your entity right now because it's got to be a Delaware C Corp. Otherwise, we're not going to write the check. So oftentimes it's very important anytime you're giving away shares or raising money, whether it's thousands or millions, that you've got that kind of structured protection. However, a C corporation is not favorable from a tax standpoint. And I'll cover that in the next slide here that gets into why, but you can see it there if you can read fast and I can speak. It is subject to double taxation. I'll talk about that in just one moment here. So what you can see here is we have main tax points across the 4. So if you're a C corporation, what's going to happen is you're going to be subject to corporate taxation. So let's say you have a $100 profit. That's going to be subject to a 21% rate. By the way, there's also legislation out right now to raise the minimum tax. So even if you have a loss, you'll still have to pay 15%. I won't get into that now. That exceeds the scope of this call. But the point is you're going to have to pay $21 of that $100 profit. Okay. Now you've paid that $21. You've got $79 left. Now, when you take that 79 out as a dividend, you pay yourself, you're going to get taxed on that again. So that's why we call it double taxation. It is not tax efficient So really, when we're advising a client entity structure, we're trying to understand, are you going to have shareholders? Are you going to raise money? And for those that want to operate a certain way and then raise money, we'll often say, hey, it's going to be tax efficient to operate as an S Corp, for example, and then maybe spin out this business into a C Corp if it's 1 year, 2 years down the road, because it is going to hurt along the way. The second one that we have listed here is the single member LLC. For those of you that are maybe sole proprietors, starting your own business, no partners, you're going to set up an LLC. You're going to be considered a single member LLC, which is taxed the same as a sole proprietor. The big headline on that income is that it is subject to self-employment tax. We've got a model slide I'll cover quickly in just 2 minutes that'll show you how painful that self-employment tax can be. But that's the headline. You're subject to self-employment tax. C Corp, you're subject to corporate tax. Single member LLC, sole proprietors, you're subject to self-employment taxes. When does this get good? Well, not in a partnership, because you're subject to the same taxes. So partnership, you'll also be subject to self-employment taxes. You just have additional partners. So, okay, now I've got these self-employment buckets. I've got this corporate tax. Where does it get good? Well, I don't know if it gets good, but it gets slightly better with an S Corp. So with the S Corp, there is no corporate tax. It all flows through to you. And there is no self-employment tax on the income. So that's 15% of taxes you otherwise would have paid. What's the catch? You have to W-2 payroll yourself. That's why I said there has to be enough scale where you're going to pay yourself a reasonable salary, because big risk, okay? For those of you thinking you're going to leave the call right now and say, hey, I'm going to go set up an S Corp, understand that the big risk with an S Corp is that you don't pay yourself a sufficient salary. You underpay your salary, the IRS comes in and they say, you know what? We're going to treat all of it as self-employment income. And now you've just reversed everything out. So make sure if you're an S Corp, you're ready to W-2 yourself a comparable salary. And we have a few ways that we calculate that to make sure that the IRS is going to come in and say, hey, you're abusing the S corporation tax benefit. I am going to try and wrap these up. Why don't I give you the bottom line? We've got 2 columns, left-hand side, we've got an LLC subject to self-employment taxes that at the end of the day, their total tax is going to be let's call it $27,000. All right. Again, just bottom line, second scenario, you're an S Corp, same amount of income. In this case, we pay wages of $30,000. Now, this is just for modeling purposes. Okay, I'm not saying 30,000 is reasonable, but if you pay a W-2 of 30,000, you now have your distribution is different. In case A, your distribution was 90,000, you were taking that out, all as a distribution flow through. In the second case, you're taking 30 of it as a W-2 salary, and you're taking 60 of it as a distribution. By the way, you don't need to run payroll the whole year. We have certain clients that in the first year, we do have to run the full 30,000 as a W-2. But the point is, you've taken it on the chin for the W-2 salary, because as you know, there's quite a bit of taxes that come out of a paycheck. But even when you factor those in, the total tax paid is less than 20 grand. So the effective tax rate difference in this case is something like 7 grand. And we're talking, I mean, I don't know if these are big numbers or small numbers, but even on reasonable numbers that we'll typically see, this is a change that can easily keep $7,000 in your pocket instead of going to the IRS. And typically, I like to not have to leave a tip to the government if you don't need to. But if you do like paying $7,000 extra taxes, stay in LLC, and there is no special place in heaven for paying more taxes than you had to. So with that, I'm going to just wrap up on some must points on the S Corp again. Don't want anyone to leave here without that point number 1. You need to pay a reasonable salary. That is going to change for different industries. We have ways of benchmarking it. There are ways to look at it as a percentage of your net income. And again, that's going to depend on the type of industry. So take a screenshot of this. I'm going to wrap here. And now I have the pleasure of handing things over to Danny, who's going to talk about the legal side of entities. Danny, I'll hand it over to you.
Okay, hi everyone. Can everyone see my screen? You can nod if you see it. Looks good. Okay, great. So from the legal side, I want to talk a little bit, why would you care? And so many people, how does this come up? We're talking about entities, it's kind of abstract, right? So practically, what are we talking about here? As a business firm, people will call us and say, look, I'm looking to either form a business, or I want to sell something, sell my shares. I'm looking for an exit strategy. What are my options, or what should I be doing to think along these lines? Or look, my husband wants to start a side business, and I think he should form some sort of entity. How can you help us? One mistake people make is they try to do it themselves. In reality, you really should be talking to the CPA or your accountant side, and talking to your lawyer. And obviously we don't get into the tax side, but we do get into some considerations that tend to be overlooked. So there's a number of considerations, and why do we care? Because there's a combination of tax, legal, growth strategies that if aren't taken into consideration at the outset, we often as litigators can see these turn into problems later on. And as a preventative law practice, we want to keep people out of those sort of problems. And obviously, based on someone's individual circumstances, that may dictate which of the entity structures may be the best for them, as it could be more than one as an option. So in addition to these sort of four high-level issues, there's so many different things that you would have to take into consideration. There's formation requirements, there's filing fees, there's governing documents that differ based on what entity. There's certain liability issues that can come up. There's who's going to manage the business. You have to have your operating documents. All of those sorts of things need to be taken into account. And if you're small, you may not need one of the more complicated entity structures. So what are we talking about when we're talking about entities? Miguel touched on this, but we're generally talking about partnerships, LLCs, which I'll probably spend the most time on here because it's the most commonly asked sort of question we get from legal, and corporations. Miguel spent quite some nice time on S Corps and some of the tax advantages there. For partnerships, we're talking the classic is a general partnership. One thing to keep in mind is for partnerships, you need two people. We often get asked by one person if they can form a partnership, and the answer is no, you need a partner or two or more. So general partnerships are kind of the classic partnerships. The downside to these, and why they're generally, I try to stay away from them, is the unlimited liability. As lawyers, we're looking to reduce your risk. And liability sounds like this abstract concept. What are we talking about? We're talking about someone coming after you because you owe money and saying you owe the debt and trying to go after your personal assets. We want to try to protect that. General partnerships, you're not protected in that regard. Obviously, limited liability companies, that's classic for real estate investments. I'll talk a little bit about that in a second. Kind of provides the best of a partnership and a corporation. Corporations, you have the C Corp, kind of your classic corporation. Generally a better structure if you think you want the corporation to grow, if you think it may be somewhat larger. And then professional corporations don't apply to everybody. Everyone seems to think they can be an LLC. Oftentimes, lawyers, accountants, engineers, for example, cannot be LLCs. And so that's something to keep in mind. So generally, as I talked about partnerships, I'm talking about general partnerships here. The downside to them is the sort of personal liability for the partnership debts and obligations. But they're obviously much easier to manage because you don't have the sort of corporate formalities like corporate minutes that you have to take care of or consider with a corporation. LLCs, very, very common. Everyone wants to form an LLC because they do provide the benefits of a partnership or somewhat of the ease of them, and some of the benefits of liability protection that you get with a corporation. One thing to keep in mind for LLCs is that you're still not going to be off the hook for malpractice claims. So there's still some liability out there. So for example, if a lawyer commits some sort of medical malpractice, they're not going to be shielded because they have an LLC from those sorts of claims. You do have to maintain some corporate formalities, but you're not doing corporate minutes, but there, you have to have some documents here. So let me just wrap up here. But, and we have two types you've probably heard of: member managed. So members are owners, not shareholders. So when we're talking about LLCs, we're not talking about shareholders, we're talking about members. Members are the owners. So you can either have a member managed LLC or a manager managed LLC. Member managed is much more common. You can have unlimited member owners that can manage the day-to-day operations. However, there could be some circumstances where the owners don't want to manage the day-to-day operations, and you have a manager managed LLC. As a manager is appointed to handle the day-to-day operations. The corporate formalities, there are some, but they're less stringent. Again, you're not doing the sort of corporate minutes that we see with a C Corp, for example. LLCs are very common with real estate because they provide some protection there for your real estate investments. One thing that I notice, if you're wondering where do I see some people get into trouble, is they form an LLC for a VRBO that they have out of state, and they don't register it in California. That's generally can get you in trouble and subject you to penalties. Why do people, California is not the most business-friendly state, but if you live in California, you own a real estate investment out of state, maybe you're renting it, but you live here in California, you're generally going to have to pay the $800 annual fee to California, to the state. And so most people think they can get by with just forming an out-of-state LLC, like in, for example, Nevada, and then not registering it here. That's technically not advisable. We've seen people get into trouble with that. Briefly, let me just talk about corporations. Miguel covered this. Classically, we help form corporations. These are much more regulated in terms of corporate formalities. You have to have corporate minutes. You have shareholders, but you obviously get the protection of not having personal assets or personal liability for any of the debts and obligations of the company. One thing that we often see is doctors, lawyers, accountants thinking they can form an LLC and not realizing they really need to form a professional corporation. So an accountant cannot form an LLC. They're probably going to be better with a professional corporation. It's amazing how many people think they can form some of these other entity structures, when the reality is not everyone can form an LLC, and they often do that, and then they come to us with a problem when they haven't done it correctly. Corporations, again, generally going to be a larger business. So if it's something you're really thinking is going to have growth, that's where you're going to want to be. One thing to keep in mind is you can form an LLC, and if it gets big enough where it makes sense to convert it to a corporation, that's a possibility. So you're not stuck in that forever. And why do we care as lawyers? We're constantly trying to tell people how they can mitigate their risk so they don't come to us, unfortunately, with a lawsuit. And that's often where we see we get involved, because now they have a major problem. So risk of LLCs, I've alluded to this, is a professional operating an LLC when they're not licensed appropriately. That obviously can create major issues. And then for corporations on the corporate side, you have to observe these corporate formalities. So you have to do minutes, minimum of once a year. People also often ask us what needs to go into the minutes. So major business decisions need to go into the minutes. We have templates that we provide to our clients. If you would like to reach out to me after this webinar, I'd be happy to share with you one of our templates so that you can see kind of what generally should be going into your minutes. But that's important. Do not, I guess, overlook the need to do your annual minutes, because you may have a single shareholder. It's very informal. Doesn't mean that this needs to be a big process, but you need to be doing your minutes, or you run the risk of not following corporate formalities. Then if you're in a dispute with somebody, all of a sudden they're looking to pierce the corporate veil, and you're losing all of the protections that we were going for by starting, by forming the corporation to begin with. And that's what we want you to keep protected. this is a very high-level overview. We can go into much more detail to all of these issues, but we wanted to just kind of touch on the high points. And I think I was going to ask Alessa, that's all I have that I wanted to cover, but Alessa, if there's a question, I'd be happy to answer it if you've gathered maybe one or two.
So thank you, Miguel, and thank you, Danny. I just wanted to pose a couple questions to you all, maybe elaborate on some things that we've encountered before. So question for you, Danny. You talked a little bit about LLCs in the context of real estate investments. A question that I've seen before is whether or not if you really need a different LLC for each property, or can you have a single LLC that holds your entire real estate portfolio? What would you recommend?
Yeah, that's a great question. So generally speaking, you're going to want to form a different LLC for each investment property that you own. And the reason for that is, let's say you own two $500,000 properties. Someone trips and falls and breaks their ankle at one property, and the exposure is greater than that. They could look to the other property for the balance of that. If you formed a separate LLC, you're going to shield yourself from that problem. And so generally, there are some exceptions, but generally you can limit the liability if you're forming an LLC for each property. Where you might not need to do it is if you truly have two second homes that you're just using for yourself. You want to have some liability protection, but you're not too worried about there being a claim. It's just how risk adverse you are. But generally, I would say that the rule would be let us form an LLC for each investment property that you have. So good
Great.
question. Thanks.
Thanks. Okay, question for you, Miguel. So what structure has been commonly proven as the most tax advantageous? And I know that's a broad question, but hoping you can address it for us.
Great. Yeah, no, thanks for the question, Alessa. I think the most commonly tax advantageous structure has been the S Corp. I mean, I think it was written into the Internal Revenue Code, specifically with small businesses in mind. The S, in fact, stands for, could you guess? Small. So if we're talking about a business that makes between 100,000 net to even $500,000 net, it's going to be the S Corp, especially with the 2018 Tax Cuts and Jobs Act, with the qualified business income deduction. A portion of that income now is not even taxable. So you get a discount on the income itself. It's not subject to self-employment tax. It's not subject to corporate taxes. And then you're able to do things like contribute to a SEP IRA and do some tax deferred strategies that are available in others, but you can kind of, we call it the tax stack. You can stack your strategies there in a way that lets it be very advantageous. Thanks for the question.
Thanks very much to both of you. We really appreciate your time. I know that I'm seeing some questions here. So what I'm going to do is include Miguel and Danny's email addresses so that you can contact them directly to address your particular question. Feel free to reach out to us. And again, thank you everyone for joining us. We're happy to help with any of your legal or tax issues moving forward. Thanks so much.